Welcome everyone to the Pump and Dump channel. Today I would like to discuss a company called Guyana Goldfields Incorporated. It is a junior gold mine in Guyana, which is an English-speaking country in the northern part of South America. They operate the Aurora gold mine, which looks set to produce around 150,000 ounces of gold in 2019. This production could advance according to the company's data at my best guess to grow to approximately 225,000 ounces in 2020, a 50% increase. The cash costs are relatively low, around $800 an ounce based on the company's guidance of $800 to $850 an ounce. In Q1 they came in at $839, in Q2 they were lower at $746 an ounce. Guyana Goldfield is set to hit the lower end of its production guidance of 145,000 to 160,000 ounces based on the first half of the year's production of 74,000 ounces. They had a strike at the mine which lasted 3 days during Q2 and was resolved quickly. One important metric to look at is all-in sustaining costs. The company had all-in sustaining costs of around $13.25 an ounce in the first half of 2019. This comes as a result of using a mine plan previously which was not translating into reality as expected due to the grades being lower than projected. Commissioned in 2018 and completed in early 2019, a mine life plan was made which is more conservative and according to the current production metrics is also more accurate. The mine plan was made on the basis of a $1,300 gold price and left sufficient cash to complete additional capex required and a budget to complete exploration activities, meet all their obligations, and so on. Based on the results up to present, I can see a divergence of the projections in the mine plan of around 10%, meaning that they are only achieving grades that are plus or minus 90% what they have in the mine plan. Now this is okay as long as it remains consistent and does not deteriorate going forward. Given that gold has been trading at $1,400 an ounce recently, and even above, it may be around this price, and it may be around this price or above going forward. They should still have sufficient cash flow to meet all these costs as new capital is being deployed to get back on track from being a value stock to a growth stock. Brownfield exploration has shown some interesting results on their prospective targets that they are looking at to grow the company's mining operations around the Aurora mine, but with insufficient data to support expanding operations at the present, what is most important right now, for me at least, is to look at the current operations irrespective of the potential. So we will look at the Aurora gold mine only for this analysis and determine a NAV that we think would be fair value for Guyana Goldfields. So the current price is around 121 a share. I have analyzed the mine plan, I've looked at the company's balance sheet and sufficient other data, and I feel confident at around a $1,350 gold price, Guyana Goldfields provides about a 20% return at this price. Given the price being 121 as of today, well, it was yesterday at the close, but it will probably open at 121, who knows. It is clear that the stock is not very loved due to the last year's disaster when the previous mine plan was no longer workable. With gold price being very bullish and having broken out of the 6 years range of $1,050 to $1,350 an ounce, I feel that we should be applying a 10% discount rate to arrive at a fair value. A 15% discount rate scenario should also be looked at, as the company has stated in Q2 that it is still looking at alternatives for funding, which could be debt or equity in theory. However, as they have just paid off their loan facility early, new debt is unlikely, as the creditor probably wanted their money back as sentiment around the company melted over the last 9 months. And the company, Guyana Goldfields said they elected to repay it, but I think it's more the creditors wanted their money back because they were starting to feel very bearish at the bottom of a cycle. Anyway, let's continue. I think therefore we have to use a 15% discount rate as a base on our valuation, as financiers, to my knowledge, ask for 15% for a tier 2 deposit when competition is low. One could argue that with gold in a breakout bullish mode, that competition to finance a gold miner is high, but there are a lot of companies looking for funding, and this company has disappointed in the recent past. And therefore, Guyana Goldfields may be seen as a loser and be treated that way in a financing. So that thinking underpins the discount rate spectrum I think I want to consider. The gold price currently sits around $14.35. As mentioned, the breakout level was $13.50, which we could use as the floor. There is an upward price target in the 1500s. However, at this point I feel a $1,400 an ounce gold price should be used as the base case, with a range considering 1350 to 1450 as the bounds. So I prepared a table to show some valuations, and there it is. I think that, as I mentioned, at 20% discount rate and $13.50 gold price, it's 121. That's fair value I come to. I might be incorrect. Don't rely on this. This is based on my analysis, which of course I'm not going through in this video because it's quite extensive and would take several hours to present it. Anyway, I think, like, ignoring these scenarios here, I think it's still important to look at $13.50 gold price and 15% discount rates. I think that 153 would be a reasonable valuation. It's more important to look though as for a target on a gold price of $1,400, which I'm using for my base case. Even though we are closer to 1450, I still think we should be conservative and look at $1,400 gold price. At a 15% discount rate, you can see my valuation comes out to 183 Canadian per share. At a 10% discount rate, 235. At this point, I would like to also mention that I remember seeing some warrants being out at 203 Canadian, I think it was, and I don't know if they've expired or not, but the share price at 121 is way below that, so we don't have to really worry about dilution coming from that. Let's continue with some final thoughts and conclusions soon. I believe that the fair value of the company should be in the range of 183 to 235 at present, which is of course a steep discount if you're looking at today's price of 121. Looking forward, the all-in sustaining costs is lower than the current gold price, which is very good. It reduces the necessity for a financing. The management has mentioned that it is looking at raising cash, and they have been in discussions with sources since Q1, since they probably saw that the grades were not coming in as expected, and the gold price, it was possible that it would go lower, and therefore they had to look at bridging some of the financing gaps. I'll just go through this presentation. There's some interesting points here. They have a slide. Once I find it, I will talk about it. And there it is. So they modeled in their technical report a $1,300 gold price, but they looked at the downside of $1,200 gold price. At $1,200 gold price, they would go negative, and this is the main reason why they were looking at finding some funding to finance, you know, the gap between the balance sheet, what the balance sheet has, and what they would need to get through the next few years. And due to the optimized plan at $1,300 an ounce, they think that they have sufficient here. They have, you can see, like this being $100 million. This is about $30–40 million differential. They have a cushion. their balance sheet, it's mainly cash. They have their balance sheet in here somewhere. I'll just solid balance sheet. $39 million in cash. They have no debt. They repaid their loan facility this quarter. They yeah, they have sufficient cash to get through. Now, let me just find that slide again, because I wasn't finished. And it's always the slide you're looking for is always the hardest to find. Let's just put in there we go. That's how we find it. It was 1200. So they assume this optimized plan here that they have, optimized plan at 1200, would, even on the downside, they would probably have just enough. But the gold price is higher, so they probably, this line here is going to probably be a lot steeper, something like this or so. If the gold price stays higher and goes higher, then they will have more than enough, and they'll generate lots of cash flow, and eventually, you know, they probably would be in the position to pay out a dividend in the next few years, which would be nice, because that would make investors very interested in the stock, and would surely take it beyond its fair value. So there's also some, let's see, capex. They have some yeah, they have some initiatives that they talked about. They want to reduce the initial capex, the expansion capex that they need to pay down as a consequence of their mine life plan not working out as they hoped. They think that based on their mine life plan that they published, they assumed that they would have to pay $124 million initially to get the thing going, but now they think that they can save $44 million in capex, which would translate to around 25 cents in share price valuation, which would be very good. I mean, I have not modeled that in my table. I don't assume these things to be true until I see them, and this is kind of the part of investing, is you need to have like a belief that they can deliver or exceed the expectations, and when something is not priced in, then the risk of a disappointment leading to a lower share price is practically zero. So overall, this is my thinking. I like this investment opportunity. I'm very bullish on the gold price. I think that we have a chance to go above 1450, and if we can stay above there, then this one will surely go up double, maybe triple, or maybe even more, who knows. Anyway, that's my final thought about this company. I think you should of course not rely on my analysis. As I said, I did not present everything that I know, and I might have some fatal flaw in my analysis. I might be making a mistake. You should do your own research, because in the end it's your money, and when the share price is down and you're questioning whether it was a good investment decision and you have nothing to like fall back on, then you're gonna maybe make the wrong decision to sell at the wrong time. And this is part of the emotional side of investing, is when you don't know exactly what's going on but the price is down, it's very difficult to hit the buy button. But when you do know that nothing has changed, it's just sentiment is down, then you easily can press the buy button, and then you can make a lot of money. So yeah, in conclusion, I think that's going to end this video. I wish you a good day, and don't melt in the stock market.